I guess, there's a few questions we want to answer today.
Okay.
So let's get into it. So the first question I have is, when it comes to uh, the whole Fed, we thought if the Fed lowers the rates, that we're going to see the interest rates go down, and yet it didn't. And now it's like, geez, are we afraid because they're going to do it again in November and December? What is it? What does it mean?
Well, the thing about it, I think hopefully now folks have come to realize from all the discussions we've had on this show about it, and what we all saw in mid-September. What the Fed controls is a short-term rate. And of course, mortgages are long-term rates. Mortgage rates are. And so there's not that direct correlation. And so the narrative really has changed. It's still on the table in terms of the betting markets, the futures market, that the Fed's going to lower the Fed funds rate again in November, right after the election. So not that far off. And then another 0.25% in December. So that's another 0.5%. But what's happening is the narrative has changed because should that occur, lowering the Fed funds rate in the midst of a strong economy is considered to have more of a stimulative effect and could in fact be inflationary. And of course, the biggest enemy of the bond market and therefore mortgage rates is inflation. So it's kind of like things have been flipped on its head to where now the lowering of the Fed funds rate might also almost be considered not good news, because in the midst of this strong economy, it could be inflationary, which of course then even could drive them even further. In fact, one major investment house, T. Rowe Price, their economist department, they're smart guys in that company are looking at the possibility of a 5% 10-year Treasury bond yield within the next 6 months. That would not be good news for mortgage rates. So let's hope that doesn't happen.